Hey there, today we're going to talk about regulators. SEBI, which is Securities and Exchange Board of India, is the leading regulator of securities markets in India. The main responsibilities of financial regulators are to enforce applicable laws, try to prevent cases of market manipulation, ensure the competence of financial service providers, execute regular inspections, protect traders and clients, investigate and prosecute misconduct. SEBI has wide-ranging regulatory, investigative and enforcement powers, including the ability to impose fines on violators. SEBI is expected to be responsible for three main groups. Number 1, protects the interests of traders and investors. SEBI is responsible for safeguarding their interests and ensuring that the investors do not become victims of any stock market fraud or manipulation. Number 2, issuers of the securities. Companies that issue securities are listed on the stock exchange. They issue shares to raise funds. SEBI ensures that the issuance of initial public offerings, better known as IPOs, and follow-up public offers, better known as FPOs, can take place in a healthy and transparent way. Number 3, financial intermediaries. SEBI acts as a mediator in the stock market to ensure that all the market transactions take place in a secure and smooth manner. It monitors every activity of the financial intermediaries, such as broker, sub-broker, NBFCs, and etc. The body drafts regulations and passes rulings and orders in a judicial capacity, conducts investigations and imposes penalties in an enforcement capacity. Next, let's take a look at the major participants in the stock market. Domestic retail participants. These are people like you and me transacting in the markets. NRIs and OCI. These are people of Indian origin but based outside India. Finally, domestic institutions. These are large corporate entities based in India. If you guys enjoyed this video and you want to continue learning more, do subscribe to our channel and stay tuned.